To another episode of the MD Investor channel where we talk about personal finance, setting goals, achieving goals, increasing our financial IQ and that of our children so we can break the cycle of generational poverty. If this is your first time visiting the channel, welcome. Consider hitting the subscription button. Consider letting friends and family know that there's a place to go to for personal financial education. Today's video is going to be a continuing series of back to school. Kids are getting ready to go back to school, or already back in school, and there's an opportunity for the adults to increase their financial IQ. Last video we did was about stocks, and today's video is going to be about bonds. We always hear people talk about, I invest in stocks and bonds. We kind of have an idea what stocks are, a little small equity ownership position in these publicly traded companies. What are bonds? Well, you kind of have an idea already what bonds are. Essentially, if somebody was to come up to you and say, "Hey, man, I'm a little short. Can you lend me $20? Promise to pay you back." Essentially, that's what a bond is. It seems complicated financial term. A bond is basically debt. Somebody a little short, and they said, "Hey man, can you lend me $20? So here it is. I'm gonna pay you back." That essentially is what a bond is, right? A bond is basically a note of indebtedness. Normally, we borrow from banks in the form of a loan. We also borrow from credit card companies, right? So when you want to go buy your flat screen TV and you don't have the money right then and there, you take your card and you swipe it. Essentially, you're borrowing from the credit card company because the merchant gets paid 100% from the credit card company, and then you deal with the credit card company. So we know about borrowing as we being the borrower. But essentially, what a bond is, instead of we or us being the borrower, we actually become the lender. It's weird, right? But we become the lender in terms of investing in bonds. The borrowers, the person who's borrowing the money, they issue the bond. Now, who can issue bond? Well, a couple of categories. The government can issue bonds. You say, wait a minute, the government has trillions and trillions of dollars, but the government sometimes need money to fund its projects. Example would be like in the Great Depression, when after the economy crashed, after certain wars, the government needs money, and they issue bonds. So the government is one of the big issuers of bond. You might have heard of the U.S. savings bond, right? We have a picture here of a U.S. saving bonds, United States saving bonds, right? This is essentially the government borrowing money from investors to fund whatever they need to fund and promising to pay them back, okay? So essentially that's what it is. You might have heard of a Treasury Bond, right? Treasury bonds are government debt securities issued by the federal government that have maturities greater than 20 years. And they earn periodic interest until maturity. Essentially, what they say in the Treasury bond is the government borrowed the money, right? We lent in the money. They said, okay, we are going to pay you a certain amount of interest. Usually it's semi-annually or twice a year. And we're going to pay you this interest at a set rate, whatever it is, 3, 4, 5, 6%, whatever. We're going to pay you that interest semi-annually, and it's going to be for a certain time frame. In the case of the Treasury bond, it's greater than 20 years. So essentially, that's what it is, okay? It's basically debt. Who also issues bonds? Companies. It's called corporate bonds. So recently in the news, a company like Carnival Cruise Line, obviously because of the pandemic, is in a financial bind, They issued bonds. And essentially what it is they're saying, we want to borrow money from investors. We're going to pay you a set interest rate. I know some of them, they said the bond was going to become mature in 2023. So just in the recent past, we see that's corporate bonds. So the government can issue bonds. Companies can issue bonds. You may have heard of a municipal bond. Some they call it muni bonds. So certain jurisdictions. So you may have a bond from New York City or Boston or whatever, and they might issue a bond for funding capital projects, maybe a new bridge or a tunnel or some utility company they're building. So governments, companies, and municipalities can all issue bond, and the basic definition is it's a loan, and we are lending them the money. They use it for a certain amount of time, and they promise us a certain amount of interest. Bonds are considered fixed income security because for the most part, the interest rate is fixed, right? So they say we're going to pay you 4% or we're going to pay you 5%. So it's a fixed income security. So you get your regular fixed interest, whether the frequency is, whether it's going to be semi-annually, whether it's going to be quarterly, whatever it is, it's a regular fixed interest. And then when the bond matures, meaning when the time frame is ended, then you get your principal back. So if they say, okay, this bond is for 20 years, and we're going to pay you 4% interest rate, and it's going to be semi-annually, you're going to get 4% of the whatever the bond face value. You get 4% semi-annually, and then when the term is over, if it's 20 years, you'll get your principal back. So a couple of definitions. You'll hear the term face value. So here it says $100. So this will be the face value. So whenever the time frame is up here, you'll get $100. They might have bought this savings bond maybe for only, say, $50. Okay, maybe for $50, but I guess maybe here after 30 years it'll be $100. So that's considered the face value. The interest rate is set. I don't see the interest rate here, but you'll get the interest rate. You get the interest payment, however frequently it is set. Okay, and then like the maturity date. So it looks like here it's going to be about 30 years. The issue price is the price that the investor pays. So we say all that to say bonds are considered less risky compared to stocks, right? We always hear talk about the volatility of the stock market, right? Prices fluctuate up and down. Bonds are considered less risky. Part of the process of being diversified, right? Instead of having 100% of your money in stock, you want to have a little bond, and the bond is thought to be more safe. They said when you are younger, you can afford to have more of your money in stocks because the thought process is if things go bad, the market crashes, you're young, so you have many years for the market to recover and your stock prices to go back up. As you become a little older, you want to have more of your money into bonds, right? Because you have less time to wait for the market to recover. You want to have it be a little more stable. So with more stocks, the greater risk for a downturn or for your market for your principal to go down. But with more stocks, there's a greater opportunity for the upswing too, right? So it's like risk reward. Greater risk, more reward. With bond, you have more bonds. It's going to be less risk, but there's a less reward. So how do you know how much bonds you should have? There's a rule of thumb that they said you should have whatever your age is. you should have, there's a couple of rules of thumb. Whatever your age is, you should have that in bond. So if you are 20 years old and you begin investing, you should have 20% in bonds, 80% in stocks. Some say take your age minus 10. So if you're 20 minus 10, you should have 10% in bonds. Some say your age minus 20. But it really has to do with, so those are rule of thumb, but it also has to do with your risk tolerance. If you're a person who's, say, no, I can tolerate, market swings, increased volatility, I can go with more stocks. So, whatever you feel comfortable. But those are just kind of some rules of thumb. So there's some risk with bonds. Obviously, it's not as risky as stocks, but there's still some risk with bond. One, who's issuing the bonds? Because the bond is basically a promise, right? Let's make it simple. If you know that Johnny is a stable guy, he always keeps his word, and he said, I'm going to pay you back, I'm good for it. That's different than Benjamin, who never keeps his word, he's promised you in the past, and he never pays what he owes. Well, it's a little more risky to go with Benjamin because of his track record, right? So it is with bond. Who is issuing the bond? If your bond is being issued by the U.S. government, that's pretty solid, right? Because they said it is backed by the full faith and credit of the U.S. government versus some fly-by-night company who's issuing bonds. Who's this company? I don't know what's going on with them. They're full of debt, they're risky. So that's the difference. Who is issuing the bond? Who's the bond issuer? And they grade them. You'll hear terms like junk bonds or double A or triple A or AAB. The more letters it has, like A, double A, triple A, that'll be less risky or more creditworthy than a BBB, which would be more creditworthy or less risky than a junk bond. You know what I'm talking about? Junk bond, that's the worst type of bond to get, meaning they call them junk for a reason. They're not creditworthy and they are more risky. Another risk with bonds is the bond duration, right? If I'm lending you money for 30 years, like you see here, that's more risky than if I'm lending you money only for 10 years. Why? Because I'm lending you money for 30 years. That's a long time for something to happen, right? You said you're going to pay me back, but in 30 years, anything can happen. You can get sick, you can pass away, you can lose your job, anything can happen, right? So the longer the duration of the bond, generally the more risky it is. And to make it worth your while, they normally give you a higher interest rate. Why? Because you're taking on more risk. Just like with a mortgage, right? Just like with a mortgage, you have a 30-year mortgage, then the interest rate is generally going to be a little higher than you have a 15-year mortgage. Another risk with bond is the interest rate. Generally speaking, the prevailing interest rate has an inverse relationship with the value of the bond. So if we're in a low interest rate environment, the value of the bond would be higher. And if we're in a high interest rate environment, the value of the bond would be lower. Just things to keep in mind. So we already went over why would you want to own bonds? It is another asset class, right? Asset classes are stocks, which we talked about, but there's some risk in there, volatility. Another asset class is bonds. So you can make money with both, right? You can make money with stocks, with capital appreciation, when your value of your stock goes up in value, and you can make money with stocks also with dividends. Likewise, you could also make money with bonds, right? You're buying bonds and they're paying you interest. That's also passive income, right? And you're diversified. Which bonds are best for you, right? We already talked about a couple, right? Government bonds, corporate bonds, and municipal bonds. Let me add that municipal bonds, they're usually tax-free. They're usually tax-free, and it kind of makes sense because I think it's usually federally tax-free. It makes sense because it's an incentive, right? They're borrowing your money to build bridges, roads, or whatever, and as an incentive, it's usually federally tax free. So which bonds are best for you? A couple of things you want to keep in mind, even while you're considering this question. Should I buy bonds versus should I keep my money in cash versus paying down debt? Let me give you an example. If you buy a bond and it's paying you 4%, 4.5% interest rate, but you owe a personal loan or student loan at 6, 7%, does it make sense to invest in this bond where I'm getting 4% when I have a debt, my student loan or personal loan that's 7% or maybe even credit card is higher? In that case, it wouldn't make sense. Why don't you pay down the higher interest loan before you start investing in a bond that's giving you a lower return? Should I invest in individual bonds or a bond fund? So just like we have individual stocks or an ETF, which is like a basket of stocks, or a mutual fund, a basket of stocks, you also have individual bonds or bond fund, which is a basket of bonds, right? A little of this, a little of that. Let's kind of mix it around and spread the risk around. Because think about it, if you have 100% of your bonds in corporate bonds and these companies go under and don't pay, you've lost everything. But if you have a little government bond, a little corporate bond, a little municipal bond, it's a little mix, right? U.S. government is not going to go out of business, so you kind of spread your risk around. The credit quality, we talked about it, right? You don't want to have junk bonds. You want to have like AAA graded bond. You don't want to have all your bonds to be 30 years, right? You want to have a little mix, maybe a little 30 years, maybe some intermediate, maybe some 10, 15 years, maybe some 5 years. So it's a mix, right? Because we said there's a higher risk with the longer term bond. You have a 30-year bond for more risk. Okay? So you kind of mix it around, right? How much do you want to invest in bonds? Like we talked about it, right? You don't want to have 100% of your money in bonds because the growth is not as much as stocks. Stocks have a higher rate of growth, so you still want to have a little stocks and you want a little bond. But what's the mixture, right? We said maybe age minus 10, age minus 20, but it depends on your risk tolerance. Now let's look a little at some bond funds. Let's look a little at some. Let's look a little at some bond funds. So here we're looking at this is the Vanguard website. We're looking at the U.S. bond ETFs. Okay, so here we see there's different types of bonds, right? Here you see, let's look at the intermediate term bond ETF. We talk about long-term bond, right? 30 years, 25 years. And then you have short-term, maybe 2 years, 3 years, 5 years. This is the intermediate term, so maybe 10 years or so. And it's an ETF, so it's a basket of intermediate term bonds. Intermediate term Treasury. So these are government bonds, and they're intermediate term. And there's an ETF, a basket of them. Long-term bond ETF. So these are longer term, maybe a little more risky. So you see what I'm talking about. Short-term bond ETF. So these would be less risky. So instead of 30 years, maybe they'll be only 2, 3 years. Okay. Again, short-term Treasury ETF. But this is what I want to look at. Total bond market ETF. So this has a little of everything. A little short term, a little intermediate term, a little long term, a little government bond, some corporate bond, maybe some municipal bond. Let's go into this total bond market ETF. Ticker symbol BND. Okay, so here we see the asset class is intermediate term bond, so midterm. This is the expense ratio. It's pretty low. Risk. Look at the risk potential. 1, it'll be less risky or more stable. 5 is more risky. See, bond is 2, less risky. Okay, at the stock, which could be more risky. Um, Now, this is nice here because what it's looking at is the composition of the ETF, the bond ETF. So you have about 58% U.S. government bonds. So those are less risky, more secure. And these are the corporate bonds. A capital A, small a. So these are more stable, more credit-worthy company. AA still stable. B would be maybe a little less. But you see how it's kind of mixed, right? This is how you spread out your risk. We're not gonna go too much more detail, but it's basically to show you that in terms of the bonds, you can buy individual bonds or you can buy a bond fund, okay, which is spread the risk around. And ticker symbol BND from Vanguard is a good one, guys. So, guys, just a little financial education for the adults back to school. Like we talk about the stocks a lot. We don't really talk about bonds, so I just want to talk about bonds today. So, guys, just remember to continue to command your money to grow. Continue to increase your financial IQ and that of your children so we can break the cycle of generational poverty. And I will see you on the next one.